Welcome back to Money Discourse. Coming up, the Fed has finally paused interest rate hikes. Is China's stimulus going to put things at risk? The AI tech stocks that are booming. And is this just a FOMO rally or is there something real behind this? Rajan, take it away.
Yeah, well, firstly, yes, I mean, we had all the central banks come out last week. So on the macro front, like you said, the Fed paused. This is the first pause in, I believe, around 10 meetings in which about 500 basis points worth of tightening has happened during those 10 meetings. And it's the first pause, but real quick, so that was a positive, but there was talks that it was more like a hawkish hold rather than a hold like this is the end. So what happened is the Fed projections, the dot plot now is forecasting a higher rate than what was prior to the meeting. So it looks like that there's room for further rate hikes, which was a bit more hawkish than expected. So that sort of took the market a little bit, but I mean, it didn't really stop the market from rallying last week still, apart from on Friday where we had a little bit of a little bit of a pullback to this mad rally that we've seen so far in this year. So the thing is that, so there was the Fed, the ECB raised rates, and it looks like they're going to continue doing it. The Bank of England, they raised rates too. And the thing is, the Bank of England, I mean, the UK has got the highest rate of inflation, Europe next, and then the US is starting to subside quite a bit. So the thing is that all of these central banks, the main message that's come across is that they're going to continue to do what is necessary. So if with the Fed, they basically said if data points to a more expansionary environment, the jobs are still good, but inflation is still rearing its head, and they have no hesitation to raise rates even further. So, I mean, right now, all these central bankers, they're getting free pass because the market seems to be doing well. There's full employment. I mean, no matter what way you look at it, obviously there's individual cases on the ground where there's a lot of hardships and a lot of people are struggling. But in general, if you just look at the economic numbers, they all look really, really positive. And on that aspect, the Fed can just continue doing what they're doing. The stock market keeps on going up, even though we're at 5% rates. We ain't got no stimulus really pushing this forward. So, I mean, we're just running on AI, like you said. And so it's, the Fed can just do what it wants. I mean, it doesn't seem like there's much that's in the way for them to, that's really going to slow them down. So in that aspect, I think, there still could be a bit more to come. Things are still a bit more rampant. The housing market hasn't crashed. Inflation is coming down and stock market's going up, and employment is, near full capacity. So if they want to do it, there ain't going to be much stopping them. Like, well, that's what it seems like. So this is where we are. The S&P is above 4,400, and NASDAQ is above 15,000. So there you go.
What are your thoughts on those who, I think it's like Druckenmiller and all of those guys that are saying that we're going to hit a hard recession in Q4? Is that realistic, or are they just?
I mean, so this hard recession talk has been going on for ages, and the thing is that it might happen, but it doesn't. It just no signs. And I've said this in previous pods that you can only get a recession and a hard recession if people lose their jobs. Right? Because why is there a recession? Because people can't afford to spend, people missing payments, people are doing this. But while there's so many jobs available, employment is at the rate at which it is, like mid-freeze. And I mean, that's like across Europe as well. And while we have that dynamic coupled with decent wages, I mean, regardless of what it is, people are affording to pay for stuff. There's not as much missed payments everywhere, and I have heard like there's more car repos and things like that going on. I mean, that's because I think some people just paid some outrageously disgusting prices and some major, like 15% finance on their cars and got some ridiculous payments. And I sort of got a feeling that some of these are just like, you know what, I'd rather not just pay that to go take my car away. I don't know, but I mean, it's crazy. But if you look at the NASDAQ, I believe it's on an 8-week streak. Now, it hasn't been on a streak this long since 2019 when it went on a 10-week streak. So we're in an 8-week winning streak for the NASDAQ. You've got all the big caps just booming. And the thing is, when the stock market's going up, everybody just feels like everything is getting better, even though underlyingly there may be problems. There might be some cracks showing, and maybe Druckenmiller, maybe they might be right. But in my opinion, I think soft landing at best. Soft recession. But again, I just don't see any of that. You look around, and I'm sure you've seen it there. Everywhere's packed. People buying, just crazy cars.
We just go back a few months ago, and there were banks failing left, right, and center. Yeah. But all it just took is, we're going to backstop everything. and everything is good. Like no one's even talking
I mean,
about it anymore.
we had the fifth largest bank. Like, we had some of the biggest bank failures that just happened, and it just sort of, anyway, that's done and dusted. Let's move on. I mean, you look at some of
Credit
the stuff that's
Suisse.
happened.
Oh well.
Credit Suisse,
Yes.
Credit Suisse, Silicon Valley, all of the regional bank crisis, all of that stuff. I mean, it's just like, yeah, whatever. FTX. Yeah, let's just move on. You look at, I mean, literally 5-10 years ago, anything like that would have happened. I mean, you would have had turmoil, but right now, just like, yeah, let's move on.
Obviously, they're trying to fight the inflation. And now, obviously, we had a massive pullback in the markets and all of that. But like in terms of the actual economy itself, there's a bit of suffering for some times, and certain sectors are really, hurting with these higher rates. But it seems like most industries are adapting. The costs have been passed to the consumer, and it seems like they're taking it all.
Yeah, 100%.
Yeah.
So I mean, I'm going to just bring up a chart of the S&P 500 right now. So we've been in this range, and I've been calling that we're going to be range bound for the whole year, and then we've obviously had this breakout, and then you can see just the amount of green candles that we've got here. 1, 2, bit of consolidation, and 1, 2, 3, 4, 5, and then a big one there. And bear in mind, this big rally that we had, and that's after the Fed. There's the Fed talking about higher rates. The dot plot had increased, and the market goes flying through the roof. So it just doesn't seem like the markets care. I mean, by the way, higher rates is supposed to be a negative for tech stocks because, generally, when you use a discounted free cash flow model, that sort of brings their valuation down, and present value of money, all of that stuff. But yeah, it doesn't seem to matter. It's just like the valuations have just gone off the chart. So obviously, this is massively fueled by the AI boom. And the thing is, how sustainable is it? But like on Friday, we opened up again. And Friday was the first day where like we saw Nvidia was up $7, and it actually ended up flat on the day, where actually it gave up its gains. And I don't know if that means anything, but that's the first meaningful red candle, as you can see, that we've had coming back all the way down probably to like mid-May. Since then, we've had minor red candles, but we have not finished on a low. So if you look at that red candle over there, we actually finished
higher than
virtually on the low right there. But you look at every other one, yeah, right, this one maybe over here. But I mean, we haven't had this type of move since mid-March, so I mean mid-May, should I say. So
this all comes at the same time as for the first time ever, the yield on cash bonds and equities is the same, right? The yield in the 3-month US Treasury bills were 5.3% after the Fed held the rates, and this is the same level as the expected forward 12-month earning yield across the S&P.
Yeah, I mean, what's funny is because I mean, obviously you get a lot of people talking, and people are so, when the market goes up, they're like, why are you telling me to get into fixed? I was always like, if you don't want to stress, right? Especially if you're older, you've got your 401k or whatever it is, your pension, whatever it is, and you're getting to that age where you're about to retire and you don't want to worry about the volatility of the stock market, you're getting 5% government yield. Take it, relax. You've built up a nice nest egg. You don't have to worry about any fluctuations. But when the market then goes up, they're like, oh, I should have been in stocks. But I wanted to bring this up. So if you want to see the composition of what's been going on, and that's the real key, if we look at it. So this is obviously the one day performance, but now let's go year to date. So if you look at, this is a general S&P 500, and like pretty much most of the energy sector, which was the leader last year, is down. But if you look at performance in healthcare, even in this financial sector, we're just seeing, a couple of ones have gone above 15%, but 8%. They're pretty, modest gains across the board. The regionals obviously are down quite a lot because of the banking crisis. Healthcare as well, consumer discretionary. Again, we've seen a mixed performance out of the retailers, night footwear, restaurants. At McDonald's up 11%. But now you just look at the largest cap names. Apple 42% year to date, Microsoft 43%, Oracle 55%, 54%, Adobe almost 50%, Nvidia, obviously that's the main one, up 192%, and then Google's up 40%, Meta 133%, Amazon 50%, Tesla 111%. I mean, these are just the biggest market cap names, and they're just getting bigger and bigger. And before you know it, this heat map is going to be one massive thing like this. It's going to be like when you look at the crypto heat map, you've got Bitcoin that's basically about 75% of the heat map, and then the rest is just like little boxes. And it seems like this is how it's going to be for the S&P 500, because these big cap names, the bubbles are just getting bigger and bigger and bigger, and they're just driving so much of this performance. And I mean, I don't actually know what the composition now is. Before I knew that Apple was like 6% of the S&P 500, but now you've got to assume that Microsoft is coming close to Apple's weighting in the S&P 500. And when you then put in Google and then Amazon and then Tesla and then Meta as well, before you know it, the S&P 500 is going to be like 30% by 5 stocks, 6 stocks. So every time you play, you're literally doing a hedged outright of these stocks, and it's pretty wild. And then, so I mean, it's such a, even though the market is up so much, it is such a skewed rally. It's not a broad-based rally, and that's the main difference with this. And this is how it actually happens when you've got these companies that are so big. It might not really be portraying the full reality of what's going on in the world, because all it needs is Apple, Microsoft, Tesla, Google, Amazon to just go up another 10-15%, and this market's gone up through the roof. But there might be a recession, but if those stocks don't go down, then it's not going to really be reflected in this market. So you look at the relative performances, and I mean, we look at year to date. You've got technology, just massively outperforming right up here, followed by communication services, cyclicals, and then after that, you see all the other indices, and it's pretty much modest gains or modest losses. And then even on the 1 year front, real estate is obviously the laggard over here. Energy, which was the leader, now is flat on the year. So this is how it is. And technology is having the same type of run it did in coming out of the pandemic. And we're seeing this again with this AI boom. So then that leads us into the next question: is this legit, or is this like a fad? Like, I mean, should I be shorting it till my hands bleed?
No, I mean, like, a lot of these tech stocks were hit harder than the overall market. So some of them are obviously just getting back to, a lot of them aren't even, like, let's say Tesla's not back to its all-time highs, but yeah, there's others that are smashing their ATHs all the time. So well, who knows? I mean, what's interesting is like the parallel between a handful of tech stocks kind of owning most of the S&P, and it's kind of like how physics works in terms of the largest masses, like the sun or whatever, just attract everything to it. And it seems to be sucking in, especially with the AI boom right now, just sucking in all of the cash. We're on this cusp of a new computational revolution. And yeah, we're just at the beginning. It's going to be amazing to see what happens there. But what's your thoughts in terms of China and how that's going to affect in the markets? Goldman Sachs just, slashed its economic growth forecast for China on Sunday, saying that the government is basically going to be giving less support for the economy than previously thought. What's your thought on that?
Well, I mean, if you look at it in general, the Chinese stocks have been underperforming. Like Alibaba still below 100, So the thing is that China hasn't been fueling this growth anyway, right? So it's like these US big caps which have been fueling it. So in terms of the stock market performance, I don't really see it having that much of an effect. Obviously, China's consumptions of EVs and they'll always be just a huge player, but I don't feel like this rally is anything to do with the economy in general. It's just to do with. So if you're looking at a pure stock market point of view, I don't think it's going to make that much difference near term anyway, because China, if you look at the FX side, K-Web, I mean, they've been underperforming massively. I'm actually in a neutral iron condor in Baba, and I've just been playing that a lot. And it's pretty simple right now until it breaks out. And but again, I don't think until the hype around everybody FOMOing into these AI stocks stops, then I think in terms of the performance of the stock market won't really be that much altered by this China news. But in terms of how it can impact the economy, I mean, you've got to look at who's got big exposure to China, and really how much is it going to really derail those businesses. Because I think the China consumer, it's a bit like here, despite the removal of all this stimulus, I mean, the consumer is still going strong. Yeah. And I think China's a similar type of thing. Like the wealthy's got just so much money and they're just consuming like crazy. So, but if you start seeing Tesla numbers, for example, people buying less Teslas in China, then then that might be something to look out for.
Yeah, definitely. Will the US be able to cut rates if China's printing a crap ton of money for the rest of the year? China can't really grow unless its customers in the US and Europe aren't buying, right? And inflation's high. So what's your thoughts?
I mean, the reopening of China is still underway. So we there was a Marriott earnings that there was one of the conference calls I was on, and they were talking about how a lot of the tailwinds expected for a lot of these companies is the reopening. The Macau area, the casinos. When I was looking at Win, they were talking about how the China airline travel is now really getting boosted, and I think when you start seeing Chinese customers starting to move around the world more, and I think this next quarter coming up will be really interesting to see the rate at which the reopening in China is gathering steam. And then I think if that continues to happen, just generally the economy is going to be doing better, because bear in mind, they've been in a lockdown for like 2-3 years, and it's just, then finally they obviously just let it all go. Everything's all opened up. And I think it's still going to take a bit of time to unwind from that. So I think that's naturally going to be a tailwind for China. But again, yeah, I mean, the government got themselves a bit into this mess with this really heavy regulation of the Chinese big caps, coupled with, stifling everyone at home. I think we've got to see what these companies are saying in the next quarter, especially the ones with exposure to China, to see if they're seeing signs of a lot more rebound, a bit more of a rebound. It's a hard one. I can't even think. You just have to listen to the companies and just see how it's gonna be.
Yeah, and I wonder, in terms of looking at what Chamath is saying, in the most recent All In Pod, he was saying that we're going to have interest rates higher for longer than we like. That's a message that he's been iterating for the last year or so. But the interesting thing he's talking about is preparing for a bunch of companies who will not be able to refinance their debt, and thus will see their equity value incinerated.
Yeah.
But obviously, this kind of boon in the S&P and in tech stocks in general is obviously a bit of a tailwind there. But I wonder how many companies are really in the crap right now. And
yeah, I mean, that is a good point. That is a good point. When you're refinancing, when some of these fixed income maturities, or they're the ones coming up to an end, and now can you imagine all the refinancing rates, like some of these each of these 10-year bonds, 20-year bonds, if they're all starting to mature and they got a refinancing, that's going to be an issue. And that's the thing, that's where you've got to see which one of these tech companies, how much debt do they have, and then have they just gone up to the roof on this AI boom, and then those are the ones probably just to absolutely short the hell out of. I'm trying to short C3 AI, but the liquidity in that is so bad, especially on the options. I managed to get one position, but not one for the. Wait, did I get one on that for the money discourse thing? I can't remember actually. Actually, I've only got Coin, Baba, Airbnb, and Carvana. Carvana's another one that's just gone bananas. And so the thing is that, I'm trying to get a position on AI, C3 AI. It's been a bit difficult. I also was on a Friday, just had orders in to short NVIDIA, but not obviously outright short it, but just trying to sell some out of the money call spreads. Again, couldn't really get filled, but I'm still trying. I think not that I'm bearish on the thesis, but I think short term we're overdone. So that's the play that I'm looking for right now. But you're right. This the expiration of the shortest maturities, that's going to be. I guess we're going to all see how it all folds out. It's going to be.
The thing is that we've heard so many of these type of funding wall arguments over the years, and nothing seems to happen. There's always something.
It's going to be interesting. But I mean, again, I think if I had to with this move right now, I do think it's overdone. I mean, I think it's a little bit different to when we had all the previous booms. Like, first of all, it was blockchain, anything with a blockchain, and then it was marijuana, and then it was EVs. But this one, we actually seen the use cases. We actually seen products related to AI all over the place, and things that are really improving productivity, like you mentioned before. But despite that, the valuation on it is just. I mean, every conference call it's and these are the biggest companies. How many times can you mention the word AI? That's all it is. Oh, AI this, AI that, AI this. I mean. Yeah, I don't know. So that's why I think we're going to come down to earth a little bit. Nvidia now worth like 1.1 trillion.
Yeah, the thing is that I think there's still the catalyst of the Microsoft 365 launching Copilot. Once this tech actually gets into the mainstream, I know we talk about it being in a mainstream, kind of it being with ChatGPT and being one of the fastest products to be adopted in history. But the world literally runs on the Microsoft Office suite, or a lot of the world anyway. And once the average Joe gets access to the technology, which changes their day-to-day working, and even if you're a pension fund manager or anything like that, and you're seeing these tools just rapidly doing so much for you, I still think that, even though from a valuation point of view, you're right. Based on history and how things used to work, there's a tendency to say, okay, everything's a bit overvalued. Again, we don't know what the financial impact is going to be for Microsoft, how much extra it's going to bring to the bottom line. That's something we don't know. But one thing we do know is that the productivity, if these tools that have been demoed turn out to be as useful at boosting productivity, I see a continued run for Nvidia, Microsoft, even Google. I'm sure they're going to be doing the same thing with Google Sheets, and that the only thing with Google is still how are they going to be able to navigate the cannibalization of Google search, where it's you're not searching for specific links, you're actually getting knowledge back from AI chatbot. So not to say that they're not going to be able to do it. And there was actually a interesting part in the All In podcast where they were talking about CPMs actually going up, because if you are using a ChatGPT like interface and you're asking it questions, it can actually provide you, and as the AI bots actually get to know you a lot more in terms of your likes, interests, what you are specifically interested in, the ads that they can show in that UI that they have are going to be so much more targeted. To be honest, it's going to be, from an advertiser point of view, just so much more targeted and so much more useful to, and that intention where it could be, find me the best party outfits, or something like, these type of things.
Definitely.
Yeah. So yeah, we don't. I think that we're going to be in a world where, like Rajan, like you said, the market caps of these big tech firms are just going to keep on growing, and they're going to just be swallowing up more and more of the S&P. And that's just my point of view. Maybe there might be a pullback, but I don't see a significant one coming anytime soon. Like the same, I did think there has to be something that's going to happen with blockchain and crypto and all of these guys. You can see that a lot of it was over leveraged and over done from a euphoria point of view. But and because you still, the average Joe wasn't able to use crypto. That was the main thing. Whilst here, this is going to be something that's going to change everyone's lives. Again, we have to wait for them to prove it with the product.
So generally, when you have these type of moves, there's always going to be some new competitor that comes on the block. Something right now that's worth 100 million or 500 million that becomes the next multi-billion-dollar company. I guess that's the real search that what we're looking for. But again, I think although a lot of these technologies are all there, trying to find the right valuation is going to be what's going to be happening over the next few years, and what is something that can do an AI job, and what is it really worth, and how many people will actually pay to use it, since there's so much free stuff out there at the moment. But I mean, this is what we'll find out. But I want to just go into one last point. I mean, we had the Apple Vision Pro. What's your view on that?
I was really, really excited to see it. I mean, the rest of the Apple presentation seemed like a bit of a snooze fest, and then they just came out with it. I think a few things that really stand out are that, the eye tracking is and the finger tracking is something that so what Apple really do is they kind of specialize in the human interface, the user experience that they have. So with they were smartphones before the iPhone, but because you could like pinch, scroll, etc. with it, even though like Marcus Brownlee was saying that all these things were actually, now you look back at it, it's like, oh, of course it should have been like that. But it's just so amazing how, well, the tech reviewers are saying how amazing the eye tracking is, and that whole interface part of it seems like a bit of a game changer. Not the headset itself and all of that. It's just how everything is put together in a kind of cohesive product. Again, the proof will be in the pudding once we all get to try it. But I do think that they have something a lot more compelling than the Meta products that are out there. But that price tag, it's a bit of a hard one to swallow.
So you saw Zuckerberg, like what it is that they obviously compromised on a lot to get the price point to a point where people will buy it. Right now, the thing is, judging by what he was saying in his thing, that a lot of this technology they already had, it's nothing new for them, and a lot of their engineers have explored certain things. But to come out with something, because I remember when Meta came out with one of their ones, which was 1,500, and people were bulking, and then there's Apple coming out with 3,500. So I mean, if Meta did a product at 3,500, will it be anything like that? I don't know, but you would assume that they would have a lot more of those sort of technologies than they have now. I mean, I think that, of course, there's a lot of, believe what you're saying in terms of some of the technologies, in terms of the eye tracking and that. But I just think in general, the concept is just not one that will be mass market, like the phone, the watch, everything, where you can literally just have it in your hand and just glance at it, just take it out quickly, put it back. This, you need to just be immersed. There's no such thing as you put it on for 1 minute, then take it off, put it on for 5 minutes and put it off. There'll be definitely use cases across the board where, it'll be very useful. But again, as something that basically, let's just say my mum will use, or like someone like that, let's put on the headset so I can, it's not, I just don't see it. But again, we'll see how it is. Is this going to be a new product category that's going to really have mass market adoption? Not in its current form, but some of the technologies maybe can come out into some other type of product, and it could be the future. So watch this space.
100%. I think one thing to note is that for that $3,500, you get a fully fledged, M2, ultra processor. So it's actually like it's what runs the most powerful laptop. So you've got that chip within that
but of course, if you pay that money,
yeah, of course, no doubt.
Like,
but one thing that Apple kind of impress you on is like, they come out with the Apple Watch Ultra, which is only supposed to really be for like, those hardcore users, but that is like 50% of Apple Watch sales compared to the Series 8.
You know why? But the thing is, everybody, you ask them, why did you buy it? And just because it's got 3-day battery life. That's it. It was just to get better battery life, because the normal Apple Watch, the battery life is so bad. It's just that if you want an Apple Watch and you want to stay on that ecosystem and you just want a bit of a better battery, they end up getting that, because you're spending $500, and that's a great thing.
If they wanted better battery life, they could have bought a Garmin, they could have bought one of these other ones, but they don't. They want the Apple product. So I think that they will surprise on. I don't think the first gen it will be that mass market hit, but I think once they hit their stride in second gen, third gen, it's going to be very they will sell a lot.
But what it will be is the product refreshment cycle is not going to be there. Like, you buy one, you'll just have it, and then you're not going to go like 2 years later, oh, let me buy the next one that costs it. Like, I just don't see that. I think you'll buy your one, and then whatever the in-app economy system is from that, like where Apple are constantly making money while you have it and you're using it, that will be the real revenue driver, rather than someone buying a new one of these every 2 years. Because what are you going to do?
I think that's what's going to happen. I think that's going to happen. I really do. But with the Apple Watch, you could, if you had a Series 3 right now, it could still be going decent today, and you're not going to have a hugely different experience to someone who's got a Series 8 watch. Obviously the screen's slightly bigger or that, but that is a product where you can potentially use it for at least 3-4 years. But I think that the rate of change of technology for a headset like that, especially with the battery life, etc., and I think the cost obviously going to come down, and I think obviously more compelling products. I think they're obviously going to have this like pro range, and they're going to have just like a standard range one, maybe might not be, with all the bells and whistles or something like that. But I think, like, I personally think, especially with the first and second gen or third gen, you're really gonna have a 1 to 2 year cycle, not more than that. I don't think, because there's just so much to be developed on that kind of form factor, especially in terms of that big bulky thing on your head, right? So Apple didn't come out with anything revolutionary, but they have kind of put all of the things that are available in the market, but all together in this really good cohesive package, and that seems very compelling. Price aside, I think it's going to be on all of the tech news and all of the have the kind of YouTube all the click fest and all of that stuff, because Apple's iPhones used to have that, every single iPhone, there used to be such a massive buzz about it, and then it's kind of died down. Like, you don't really see that big buzz on the iPhones. But I think with this headset, you're going to just see a ton of consumer interest, even if they don't buy it, but they're just going to be so super compelled to watch it. It's something that unfortunately Mark Zuckerberg can't get in his products, even though they're cheaper, more accessible, might have 80% of the same features. I think Apple's just going to have that commanding lead, but that's just my point of view. We'll see what happens when it launches. So I think that's about wraps it up for today. Thanks again for watching. We really appreciate your support. Please leave us a like and a comment if you feel like you have any questions. We'll be happy to get back to you. And
and we'll catch you on the next one. Thanks for watching.
Thanks.